Guys, in this video, we're going to talk about the covered call strategy. We're going to talk about what it is, why we would use it, and in what environments would we like to use this. Now, we talked about the short call last week, and what we said is that is going to be an undefined strategy, and we said that it was also called a naked call or a short naked naked strategy, and all that means is that it's undefined, it is unprotected. So our max loss last week, if you remember, for our short call strategy was undefined and it was infinite because we have no idea how high the stock can get by a certain amount of time. So let's just take, for example, Palantir. We're in our May monthlies here. We're just going to sell the straight 21 call. And remember, if the stock price goes up to 22 by May 21st, well, guess what? We are now buying 100 shares at 22, selling them back at 21. If it goes to 24, then we're buying at 24, selling them back at 21. And what we're doing is we're taking the width of those strikes there, subtracting our credit received, and that's going to be our max loss. And it's infinite because we really have no idea how high that stock can go. So what we do is we're not buying stock to protect us for the short call. We sell short calls to protect our stock. And that's why this is going to be a covered call, because our call is actually helping out our stock. It's not the stock helping out us out on our short call. I mean, you can look at it however way you want, but usually that's what you have because you want to be long stock. You never actually want to be short stock a lot. You know what I mean? Because everybody has 401ks. The general consensus is the stock market needs to go up. That is the sign of a good economy. So that's why everything everything is long. Everyone's long. The whole game is to buy shares of stock and just hold on to them. But if you can reduce cost basis and add a little protection, then that's what you want to do. And that's what we're doing here with this short call. We're not selling a short call and then going, oh gosh, I don't want my risk to be undefined, so I better buy 100 shares of stock against that, if that makes any sense. Sorry, you can look at it however you want it. That's just personally how I see it. So anyway, we would have 100 shares of stock. Let's just say we're in Palantir here. And what we would do is we want to reduce our cost basis just a little bit. So we would go in here and we would sell an out of the money call. So right now we're going to sell this 21. What we're saying is that we need Palantir to stay below 21 by this May expiration for us to realize this $83 premium. So we're selling this 40 delta out of the money call for 83 cents. And what we're doing, or I'm sorry, 81 cents. And what we're doing is we're saying, well, we want Palantir to go up, but if it doesn't go up, like if it stays flat or it goes up just a little bit, it doesn't pass that 21, then what we're going to do is we're going to collect this 81 cents. Plus we're going to realize however much move we get between this 19 and 21 by this May monthly expiration. So the stock goes up $1. Well, we just made $100 because we have 100 shares. And also it stayed below 21. So we realize this other 81 cents. We have a profit of 181. All fine. So what happens when the stock actually does breach the short strike? So unlike the short call where it's naked, where it's by itself, we're not buying wherever the stock ends up. We're not buying more stock up there. Okay. So if it Palantir goes up to 23, 24, we're not purchasing another 100 shares. We already have 100 shares. So what happens is because we already have our 100 shares, no matter how high Palantir goes up above 21, we already realize our max profit because the most that we can, or when we get our shares taken away, we bought them at what, 1983, something like that, 1975. The most we can get them taken away at is 21. We're not going to get them taken away for higher, for less. We're not going to purchase more shares than sell them back for less. No, the shares that we already have, we're just going to get them taken away at 21. So that's going to be our max profit, which is this $200 right now. I'll go to another page here so you can see how this works. And you can see that our shares are right here. We're selling this 21 call right here against our shares. And you can see once we get to this 21, that is our max profit. That's the $200. So no matter how high it goes up after that, the most we realize is only $200. So you don't want the stock to just rip past this because you just are missing out on all the rest of these gains. So what you want to do when you play this type of strategy is you want to be far enough out in time and you want to have a not a really close in the money delta, but you don't want you don't want like a 5 or 10 delta either. So you want to look at the 30, and anything between 15 and 30 would always be good, especially find something with call skew. That always works as well. And you want a little bit of high IV in there. So if you do end up um let's just say pulling back a little bit or staying flat, you're still going to realize a little bit of premium here, and it's just going to reduce your overall cost basis. Now, for our max loss, what are we looking at? Well, our max loss right now is $1,900. And that is because what we're doing is we're saying we already have 100 shares here at 19, okay, or at 1983, 81, somewhere around there. And then we are going to lose. This stock is going to go to zero by this expiration. That's our max loss. That's all that is. So if I go back here to the curve, you can see that this curve just keeps on going down and down and down and down the further lower we get. That's just because that max loss is, our loss is going to get greater and greater and greater the further the stock declines in value. And that's just because we already have 100 shares. That the loss has nothing to do. If it stays below 21, the loss has nothing to do with the short call. We stay below 21, then we're only realizing profit here with this call. So what that means is, yeah, we purchased these at what, 1983, 81, somewhere around there. Stock goes to zero. This 83, 81 cents, we actually made that in profit on our call side, but we still lost. We're still down to zero on our actual stock position. So that gives us our max loss of 19. So that's all that means there. So this is a covered call strategy, and all it is used to reduce cost basis. And if you think a stock is only going to just kind of stay flat and you want to suck some premium, but you're in there, that's why you would use this sort of strategy. It is also the back half of a wheel strategy. It's a very common strategy called the wheel strategy. We're going to talk about that later. But that's why you would use this sort of short covered call. And again, your max profit, it's only going to be the width between where your strikes are, or where your 100 shares of stocks are, and then your short strike. So you're never going to realize more profits if the stock keeps on going up here. So that's why you want to be kind of far out, because you want to realize, like if we were up here to this 24 and the stock goes up to 23, we want to realize all of that in our stock position. That's $400 that we could have, rather than if we sell the 21, well, now we're only making the 200, and then we're losing this that we could have had. Whereas if we're at 24, well, we're realizing this 400, then we're also gaining this 27 cents as well on that. So you got to kind of pick and choose where you would like, but anywhere between that 15 to 30 delta range, especially with the call skew, with a high IV environment, that's really where you want to be putting this strategy. So, okay, guys, if you had any questions, feel free to reach out. I will try to answer them as quickly and as efficiently as possible. But thanks again for watching. Make sure to check us out on social media. We have attached links to our socials in the description, and we also have a swing trading service if you're interested. There's more information in the description below.